Welcome to the Wiser Retirement Podcast. We believe the best financial advice should always be conflict-free. I'm your host, Casey Smith, guiding you to financial freedom. It's my co-host today, Andrew Pratt. Hey, Pratt. Andrew.
Hey, Casey. How's it going?
Good. So I am in not so sunny Florida, where it's warm and drizzly, and you're sitting at my desk. This is weird. This is what everyone else sees, I guess. I
Yeah.
feel like I'm
Sitting
the man on the outside.
at your desk looking at a cloudy and slightly cold day here in Marietta, Georgia.
Well, I do miss Wiser Global Headquarters, but this is a horse week for us. My daughter is competing at Terra Nova, which is just outside Sarasota. So don't get down to Sarasota very often. It's kind of nice down here, actually. Explains why the home prices are crazy high. Everyone wants to come here during the wintertime, I guess. So let's talk about the 60-40 portfolio. So if you're, I think most people kind of know what we mean when we say 60-40, but basically that means 60% stock, 40% bonds in a portfolio. Historically, it's been a very efficient portfolio to invest in. I think it's honestly, it's my favorite retirement allocation. We favored 70-30, I guess, for a little while because of hardly any yield in bonds, and for a while there you got more yield in stock. But the bond yields are coming back up, and I just everywhere I read, 60 portfolio is dead, 60-40 portfolio is dead, and honestly, what it comes down to is you can't believe anything you see or read these days.
Right.
Because, this is my opinion. I came back from the Schwab conference in Philly a few weeks ago. They had a whole panel on this, and everybody on the panel had an incentive for you not to buy a 60-40 portfolio. They were alternative investors. They're pushing some tactical strategy with a mutual fund or whatever it was. I still tell people I think it was 2 Christmases ago, I was reading this great article in the Wall Street Journal on why value investing would be the way to go forward and no longer growth investing. And I sent it to Brad Lyons at the time, who was doing your job, and he responded back. He says, "Well, look who wrote it." And sure enough, it was like one of the biggest value fund managers.
Yeah.
So yeah, it's like, yeah, of course you're going to write about that. That's your agenda,
Right.
which is so frustrating. So I wanted to do a little quick segment here on the 60-40 allocation, and perhaps its depth has been over exaggerated.
Yes. As you mentioned, there's a lot of noise out there, clickbait, I guess, if you want to call it that. We'll be honest though, the 60-40 portfolio had a rough year in 2022, and I think that's where some of these, whether it's news publications or fund managers, they're trying to pick on it because the 60-40 portfolio actually over time has done very well. And as you mentioned, it's a simple asset allocation strategy. You can create it in a low cost and an efficient manner. And everyone's trying to sell you not everyone, but a lot of people are trying to sell you something that's more complex, and trying to get your business that way. So I think this was a good time to pick on it after 2022's performance of that benchmark portfolio. But again, it's done very well, since, if you go back, I think in the 1920s, over, almost 100 years, the portfolios on an annualized return basis has returned over 8%, which I think most investors would take that any given day. And then, we at Wiser look at risk adjusted return, and not just looking at, the return side, but also the risk. And the 60-40 provides good balance. It's a moderate return with a moderate level of risk. And this diversification does over time, help provide good risk adjusted returns to the portfolio.
Yeah, when we do financial planning, we don't even account for an 8% rate of return. Our assumption is the most aggressive portfolios could be around 6.6, 6.7%. Retirement portfolios are going to be around 5 to 5.4%. So the fact that it can outperform a retirement benchmark is good and should be expected. I will add too though that most investors don't get an 8% rate of return, and that's
Right.
because they do things with their money like going to cash at the bottom of financial crises.
Yeah,
That's
they're
really
return
lose.
chasers. Yeah. And there'll be
So
like a bad year like 2022, and then they'll, you know,
now,
change.
why was 2022 so bad for a 60/40 portfolio versus any other portfolio?
Yeah, so 60/40, 40%, that 40 is invested into the broad US bond market index. It's changed names recently. It's the Bloomberg US bond aggregate. I think most people probably know it as the Barclays US aggregate. But typically, you know, bonds and stocks do poorly when there's rising inflation and or rising interest rates. And starting in 2022, we had the Fed raising rates to sort of tame and combat inflation. And they raised, now we're sitting at 5.25 Fed funds rate. And, we have to remember we were starting at zero. So the Fed raised interest rates 21 times in order to sort of fight inflation and slow economic growth in order to do that. So in that type of scenario, bonds and stocks underperform because, higher rates affect prices and valuations, both on the equity and fixed income side.
So, for example, the 10-year, what's it at now? 4.8%, somewhere in there.
Around there, it dropped yesterday, but yes, it's hovering around
So,
the area.
so maybe 2 years ago, that 10-year was really low, like what, 1-2%, somewhere in there.
Yeah, yeah, definitely.
So, so basically, if you took all your money, you bought a 10-year treasury, which is a really, really safe investment, you weren't, you were hardly keeping up with inflation. So people would take additional risk and go to the stock market, and you get a higher yield. You get what, 2.5% for a while there, and the S&P is a little less than that now. But you was willing to take, you were willing to take on the volatility of the market to get that yield and potential growth going forward. So the 10-year becomes kind of like your risk-free rate. So think
Right.
about it this way: if your risk-free rate now jumps to 5%, which is insane to think about, from where we were even just 2 years ago, but especially 3 years ago. So a 5% yield rate of return. You think about you're getting that right now on cash accounts in some cases. So a 5% rate of return to take on no volatility risk in treasuries, and then comparing that to the market, that means the stock market has to do better than 5%, or else why would you even invest in the stock market at
Right.
this point? Right.
Yeah, and
So
then
so that so that whole
right.
process is money reshifting. That means that a private equity guy who used to do really good 10, 15% rate of returns, the private equity guy, he's got to go do something closer to 15 to 20 now, right? To
Right.
make it worth, maybe higher than that, honestly.
Yeah, and as you said, I think the long-term average for equity, U.S. equity volatility is 18%, and why take that risk on where, just based on expected forward valuations, they're similar to where the valuations of risk-free bonds are. Why take that risk on when, again, risk-free bonds are a 0% volatility? So yeah, there's that thing to consider. There's also, if you're in a distribution phase in retirement and or like a endowment or foundation that is seeking like a 6%, 7%, or even less return for your portfolio, it makes sense to sort of rotate in these, um, you know, into fixed income that's less risky, that's yielding that, these longer term bonds that have those higher yields.
So basically, rising interest rates is what broke the 60/40 allocation in 2022. How bad was it? Like, how bad? I know that there's very few times in history we had that much of a drop in bonds and stock.
Right. Um, yeah, so that's I think the third worst performance of the 60/40 portfolio over the past 95 years. So, but then again, so it's down about 16% in 2022. Uh, if you look this year in 2023, that benchmark portfolio is up about 9%. So already we've, recouped about half of that. But yeah, the portfolio does tend to not do well in, high inflation periods, and then also significant, risk off periods like recessions.
Are you curious why annuities keep coming up as a potential investment option? People are often told that annuities can effectively mitigate investment risks and help secure their financial future. However, annuities often benefit the salesperson and might not be the best choice for you as a consumer. To learn more about the various types of annuities, the negatives of owning them, and better investment alternatives, we have a free ebook on our website just for you. To download our ebook, Buyer Beware, Why Do They Keep Trying to Sell You That Annuity? Simply click the link in the episode notes or visit wiserinvestor.com/guides. Now let's get back to the episode.
So Andrew, have you looked at the allocation or the performance difference between inflation periods or interest rate periods where interest rates are coming down versus going up?
Yeah, so haven't specifically looked at the average for, when interest rates have gone up and how that portfolio is underperformed. But, when interest rates do go down, which there are two significant 40-year periods, one from 1940 to 1980 and the other 81 through 2021. The 1940 to 1980 period, the portfolio returned about 8% annualized, and then 1981 through 2021, the portfolio returned 10.5% annualized. So, and then I guess just for an example of a rise in rate environment period, we can just go back to the 2022 return where the benchmark portfolio was down 16%. So you can see, generally over the long term, rates are, once inflation's under control, and interest rates are falling, the portfolio does perform well over those long periods of time.
So, and this is nothing crazy. This is not like a special wiser and model. This is just stocks and bonds, right? That you looked at that time period with, and which kind of brings me to the point of, why do we make investing so complicated? Like, why is it that our industry thinks that there's this secret sauce? Because 10% per year or even 7% per year, there's no way that active managers are ever keeping up with that.
Right.
Statistically, it's going to be impossible. But yet, you sit down with other advisors in the industry and say, oh, no, I have this secret formula that I do. And I can't tell you exactly how I create it, but I'm going to charge you 2.5% per year for the strategy. And in the end, you've been better off with just a simple allocation, a fund that represents all the stocks and all the bonds. And, I'll answer my own question. The problem is human nature, right? Because when it goes sideways, like 2022, we assume that it's broken, we liquidate it, and we go and find the next gadget. In the meantime, we've lost the ability to participate in the rebound.
Yeah, I feel like it's Baskin Robbins with some of these portfolio managers, the new flavors of the month, and they're return chasing and just really what is the most attractive investment based on that recency bias and the recent return history.
So when we look at a 60-40 portfolio, we're only talking stocks and bonds. We're not working in gold. We're not doing real estate. We're not doing anything special in that allocation. And I think that that's what a lot of people try to do is they take that pure 60-40 and they're going to put a 10% sleeve of something else,
right,
or a 5% sleeve of something else.
And also to kind of add on to that, it is U.S. stocks and U.S. bonds.
And yeah, that's true. And so international would be another diversification. Although you could argue that the S&P 500 is pretty global investment at this point.
Yeah, if you do like a revenue history, or I think it's if I remember, I think it's 45-50% ish of the revenues are from multinational companies that are in the S&P 500. So yeah, I guess from that perspective, it is global.
So we think about like the worst ever years, you're talking about 2022, down 17%. During the Great Depression in 31, it was down 27. During the 1937 crash, it was down 20. So from modern history, this was definitely the biggest down year at down 17% in 2022.
Right.
The next worst one was the bear market from 73 to 74. It was down 14. Interesting enough, the .com crash, it was only down 4.9 in 2001. The great, in 08, it was down 13.9. That's pretty good. Partially because bonds typically move up, right? When stocks are falling, people are running to it's the fear trade. People are running to those bonds.
Yeah, it's a flight to quality or safe haven assets. Usually in recession time periods. But yeah, and also too, how it's defined by the National Bureau of Economic, how they define recessions, whether it's post rate cuts or not, bonds should outperform, if rate cuts happen. And the reason why is because, again, not to get really technical here, but they have this, especially bonds with longer duration, people are willing to hold a bond that has a locked in yield for just say a 10-year bond that has a locked in yield, and if rates are cut, they're investors, obviously those bonds are more attractive because this bond's paying a higher yield versus just say rates were cut back down to zero versus essentially a bond that's essentially paying zero.
So when we think about stock bond correlation over time, do you feel like that stocks and bonds are becoming more correlated now? I mean, that's one of the things that people say about modern day investing, and specifically the 60-40 model, is that there's no reason to own bonds anymore because it's almost correlated with stock. They move up and down together.
Yeah, and this is something we did look at. So stocks and bonds are more correlated. If you look at over the past 1 year, they're about they have about a 0.78 correlation, and that correlation again just means that they would move in lockstep. So a zero correlation really means there's no relationship between two asset classes. A 1 correlation means that they're perfectly, I'd say perfectly, but they move in sort of lockstep. And then a -1 correlation on the other side means that they actually move in exact opposites. So over the past year, stocks and bonds have been fairly, highly correlated compared to their long-term average. So that 0.77 is very high. If you actually just go back over the 10 years, stock and bond correlation has been around 0.3. You would expect it to be, flat, maybe slightly above 0, or maybe even slightly negative. But if we go back over the past, 45 years, that average is, I think, like 0.2 of a correlation. So obviously compared, from today to the long-term average, those two asset classes are very correlated.
But through history, this has happened before.
Right.
In the 90s and the 80s, there were time periods where stocks and bonds did approach near perfect correlation. That 0.78 seems to be the high point. So it'd be very interesting to see what happens going forward, especially if we have a recession looming in the next year, which is a whole nother conversation. That's when I would think that bonds would suddenly become uncorrelated with stocks as people make shifts in their risk tolerance.
Right. I think also too, as the market expectations for inflation and rising rates, since the most recent Fed meeting, those have started to fade. And actually, a popular tool to look at that you can just Google is the CME, the Chicago Mercantile Exchange Fed forecast tool, and it shows where the market's expectations are on future Fed rate interest hikes. And looking 1 year out, you can actually have a forward outlook. Right now, there's essentially zero probability that will be another rate hike from here. And this is actually has been coming down over the past several months. And then, just to put it in perspective, 1 month ago, we were at 7% for one more rate hike. So the market expectations now are saying that there's no more interest rate hikes. And that's also, it's been coming down from the communication from Jerome Powell at the last Fed meeting. And also yesterday's CPI print was beat expectations, beat meaning that it was lower than inflation was lower, core inflation was lower than what the market expected. And also based on that, the market is pricing in less interest rate hikes.
Which
I say that
also means that there's a chance of lower rates going forward, Fed lowering interest rates.
Right. And I say all that because this is when bonds tend to do well, is when, because the main concern is that there's going to be an unexpected rate change from where we're at now. So now, based on the recent events, the market is yields have been coming down lower, and then as we spoke earlier, longer duration bonds have been outperforming ever since November 1st. Whether that continues to hold true or not, we'll see. But again, it's just, if there's no more interest rate hikes, even if the Fed holds steady from here on out, investors in the market will start to price in lower rates and yields. And that's what we've seen in the past few weeks with yields coming down.
So I think what we're summarizing here is that the ETF or the 60-40 portfolio is certainly not dead. Probably the best time to be retiring and building a 60-40 allocation.
Right.
And, sometimes you just have to wade through some nasty times in any investment strategy. I don't know of any investment strategy that's been straight up the entire time.
No. Sign me up for that one when you find it.
I know, right? But that's what people expect. That's the expectations people have, is like, oh my gosh, in 2022, I'm tired of losing money. But then if you look at their portfolio over the last 10 years, it's been an amazing 10 years, even at the worst point in 2022. You look back, you're just like, well, you've had a really good 10-year run. This is a little tiny blip across the screen versus where you've been and probably where we're going overall.
Right.
So another thing I'll add too is politics and portfolios. I think 2024 is going to be a horrible year to be a financial advisor, just from a politics standpoint. Probably a horrible year to be working at a college. Those young people energized with all political action. Can't imagine what it's going to take to keep college campuses civil, or even the coffee shop civil. Honestly, I think. Because we're looking at another rematch, Trump-Biden, and Trump's got more baggage now than he had in the first two times, right? So it's just very polarized. And the bottom line is, in a 60-40 model or any model built off of index funds, it just doesn't matter. It just doesn't matter.
I completely agree with that, and to stay the course, because if you, just for example, if you go back to the 2016 election, everyone was touting, oh my gosh, this is going to be the best time for financials and energy stocks with Trump, with his policies. And it was actually, I think during that period, it was one of the worst times for those sectors. So again, you can't really game plan for that, or be very tactical around what you think the policy moves will be with the current president. So again, just stay the course, and then just buckle up for the volatile periods.
Yeah, the only way to reduce that volatility is going to be short-term treasuries. I think that's what it comes down to. I just go back to my litmus test. Do people still come here to start companies? Is this country still operating under free market capitalism, where a person can be born with nothing, have the ability to climb the ladder and build something? And I still think the answer is yes. I think we live in a world where people are playing the victim. There's a lot of people that have opportunities who won't take it and say, woe is me, and blame everyone else. But I still meet many young people now coming up through adversity that are going to be rock stars, or already rock stars where they are. And that's always my litmus test, is hey, if the government starts taking over industries, then we have a problem, and maybe this is no longer the best place in the world to be conducting business. But I think the bottom line is politicians can do some damage, but there's nothing that really squashes the American economic system, really. When it comes down to it, people working, doing the work that has to get done, and that's what you have to focus on when you're looking at the stock market long term. Is like, is this still a place we can do business? Even with just all the wokeness that's going on in these large S&P 500 companies, which we have a tremendous exposure to. The bottom line is they're all having to do it to check a few boxes to make sure they show up in the biggest investment.
Yeah,
The bottom line is we don't have to do anything with ESG investing. It's all ESG investing at this point. Just whether or not you're going to pay for a label at 15x the price of the standard index. But again, is this a place where you still can do business? And I think the answer is resounding yes.
Right. And again, the primary goal is your target rate of return to get you to retirement, and whatever goal you set, excuse me, to meet that objective. Wokeness aside, that's what we're here for, and that's we're building portfolios to meet those objectives and sort of filter out the noise from individual companies, and that's why investing in broad diversified indexes, there might be some in there, but it's still at a very minimal, on a whole absolute level, it's a very small percentage if you're invested in an index fund that has companies in it.
Yeah. It's like I tell my teenage daughter, right? This is where all the girl drama is, and you have to be 5 notches above that, right? like you see it, you observe it, but you don't participate in it, and you got to be above it. It's the same way with politics and investing. There's all this noise and nastiness, and then the bottom line is you got to take yourself above it and not participate in it, because nothing good comes of it. In the end, you own 6,700 companies, you own 12,000 bonds. It's not going to make or break a portfolio, which is how it's designed. And statistically, you have a 98% chance of beating every active manager out there just by owning the raw index. So it's I don't know. I'm not looking forward to it. New Year's Eve of 24 is going to be hopefully the beginning of a very short year. Let's just hurry up and get through it.
Yeah, and that is one big issue if you're trying to pick and choose names, and you have a smaller portfolio with individual companies, is you introduce, it's called unsystematic risks or unique risks, and that you're essentially diversify away with investing into a broad index. But if you have, like, just say 20 names in your portfolio, you introduce this other level of risk, and that could cause your portfolio in itself to be more volatile than the broad market.
Yeah, we've seen that with just some of our prospective clients, right, where they pick these safe names in their portfolios, and they build their own stock portfolios, but they've underperformed their benchmark by double digits because they don't understand how to build a diversified portfolio. And you're right, it takes 16 to 20 individual stocks to replicate a diversified portfolio, but you still got to pick the right ones in the group. So yeah, it just comes back to I don't know why people make investing so complicated. We have to have simple portfolios that work. It works good, lasts a long time, and we have to focus our time around the planning. All the other things that well, I say no firms, but many firms don't even focus on is the plan itself. Once you built this plan, then the portfolios will have that purpose, and you'll understand what the objective is, and not to tinker with something. But I will say that for us, Andrew, I'll shift gears. I'll surprise you with a new topic really quick. We took emerging markets out of our portfolios in the last few weeks. You want to talk a little bit about that and why we decided that emerging markets didn't really have a place inside in our portfolios?
Sure, I think there's a few reasons. One is it was a very small allocation to begin with. So just from a attribution standpoint, it wasn't really providing much diversification or, differentiation from that regard. But also too, if you just look over the long term, it's really hard. And I think not to kind of get off passive, because I am a strong believer in passive, but I think there are some areas where active can do well, and I think passive emerging markets is not one of those. It's really hard to kind of navigate the different geopolitical risk, and in a passive fund that's looking to get a market cap weighting to those types of risks. And so that was the other reason. And then a third reason is just really just looking at the return and risk characteristics over the long term. And it, had a worse profile from both a return and risk standpoint compared to like a broad international developed fund. So based on all those reasons, we decided to remove it from the portfolio.
And then we removed the real estate investment fund also.
Yeah, and somewhat similar rationale, obviously geopolitical risk aside, but just looking at the long term, over the long term, total return, including, because a lot of times people tout REITs or public real estate to have a nice yield, but if you look at the total return, and it was less than the S&P 500, which is one of our core holdings in the domestic equity portfolio, and also carrying more risk. So I sort of view it as our base case benchmark is the S&P 500. If it makes sense to technically deviate away from that, then we should. But in this case, public REITs didn't really provide that value from a risk-adjusted return.
And quite honestly, a lot of our clients have second homes or large primary homes that do check that real estate box. And then our ultra high net worth clients have a lot of them have commercial properties and things individually, which is very different than owning the REIT itself.
Right.
I did notice that these flattening interest rates, REITs have gotten a little bit of a boost. So that was a little frustrating, but I think but we still look at like large office REITs. You have downtowns like just still empty. Those buildings are not full, so that's a risk too going forward.
Yeah, the risk, I would say risk on asset classes like real estate, small caps got a little boost lately because of yields coming down, which makes sense because these are inherently riskier, and with lower interest rate and lower discount rate, they're probably going to outperform for periods. But again, what we're looking at is over the long term, and building portfolios with a strategic outlook. But we still believe that these moves are warranted.
All right. Well, thanks for that update. Thanks for listening to today's episode. If you're interested in learning more about Wiser Wealth or want to schedule a consultation, meet with one of our fiduciary financial advisors, you can do so by going to wiserinvested.com. You can also click on our episode notes. In our notes, we also have a reference, episode 182, Investing for the Long Haul, Creating a Retirement-Focused Investment Strategy. Episode 165 was good, 5 Principles of Successful Investing. Kind of broke down our investment strategy. We have a YouTube channel called A Wiser Retirement, same as the podcast, where you can watch this podcast live. Pros and cons of dividend investing is one I did a few months ago. Also, two bucket investment strategy, income strategy versus total return is a video that we did for you guys. Andrew, I don't think that this podcast was as entertaining as the last one on whiskey, but we kind of gone from super holiday fun to back to business very quickly. But
I did get the invite for that whiskey one.
Right. And then I think we've got a few good shows here we'll produce here shortly as we go out for 2023. But thanks for your time. Enjoy having you on the team. And thanks to all of our listeners. We'll see you guys next week.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening. That way you don't miss any new episodes. We'd also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out. This episode was produced and edited by Ken Hoadley.